It's Thursday, February 18th. Welcome to Market Foolery. I'm Chris Hill. Joining me today, Mr. Jim Gillies. Good to see you, my friend.
Good to be seen, Chris.
We have a universal dilemma facing investors that we're going to talk about. We've got a company I've never heard of before today, but Jim is very excited to tell investors about it, so we'll talk about that. And we're going to start with the biggest retailer in America. Walmart's fourth quarter was highlighted by same-store sales in the U.S. up more than 8.5%. E-commerce sales were up nearly 70%. CEO Doug McMillon talked on the call about the investments that Walmart is planning to make in 2021, and I am assuming those comments are why shares of Walmart are down 6% this morning.
I think it's silly they're down 6% this morning. You are taking a company the size and breadth and strength of Walmart, one of the few companies left essentially unscathed. In fact, customers have been driven to them during the pandemic by the closure of practically everyone else. And you're going to take down this behemoth retailer by 6% in a day. This is if you are a long-term, if you believe that your portfolio should have what I'll call bedrock positions on which you can layer growthier, more exciting positions, because Walmart, whatever it is not terribly exciting. What a great day to add to shares of Walmart. It's down 6%. That's just my humble opinion. Look, they missed earnings guidance, or expectations, big deal. They blew away revenue. During the pandemic, their total revenues up about 7%. Their operating profits up about 10%. This is full year. You mentioned e-commerce is up about 70% in the U.S. Across the company. In the U.S., it's up nearly 80%. They made a lot of cash last year. They used it to boost the cash on the balance sheet. They took down a bunch of their debt. They're investing. I found this interesting. They're investing in what they call U.S. wages. So they're going to bring the average associate hourly rate to above $15 per hour. I know that's been a debate of some magnitude in your fine country. Walmart is kind of saying, well, we're just going to do it before we get legislated to do it. And I say good on them. Certainly competitors like Costco have been doing that for a while. So I think it's good that Walmart is, if belatedly, is following suit. They increased their dividend for the 48th year in a row, Chris. They approved a new $20 billion buyback plan. They made $26 billion last year, and they paid out, I think, about $6 billion in dividends and just shy of $3 billion buying back. This is, to channel my inner Ron Gross, this is a company hitting on all cylinders. And it's 20 times earnings too. It's like down 6% today. Cool.
Yeah,
that's silly.
The only thing I'll add is, the longer Doug McMillon is CEO of Walmart, the more impressive his track record becomes. And so, it's
2 votes.
Like the idea, as you said, for people who are building a portfolio and saying, I want to have this chunk over here that's dedicated towards growth, some high flyers, some rule breakers. I'm going to take some chunk over here, and it's going to be bedrock positions that I'm not going to worry about. Doug McMillon is a CEO that nobody should be worried about.
100%. Yeah. No, this is absolutely a bedrock position, and I've already called today's 6% sell-off silly a couple of times, so I'll call it silly again and move on.
Earlier this week, we got fourth quarter earnings from the aforementioned company I've never heard of before, Medpace Holdings. Ticker is MEDP. Medpace is in the business of clinical research trials. Tell me why you're a fan of this company.
So I'm going to try to channel.
I was just going to say, let me cut you off right now. In less than 4 minutes, tell me why you're a fan of this company.
Good luck. They're a contract research organization, but around the Fool, we praise companies, rightly, by the way. We praise companies that and we invest in companies, and we recommend repeatedly companies where we have founder management that think like owners because they are owners with meaningful stakes in the game, that, companies that, to rattle off a few, I own a few of these and admire all of them: Shopify, Appian, The Trade Desk, Starbucks for a time under Howard Schultz, Costco for a time, and we still love Costco and Starbucks, but the founder management kind of aged out. Costco with Jim Sinegal, Square. And I think I'm the only fool that's ever even noticed Medpace. And here's Medpace. It was founded in 1992 by Dr. August Trendle, who came from the FDA, the people who basically, he saw what was needed, left the FDA where he was a reviewer, and founded this contract research organization. CROs, contract research, they basically allow entities that are pursuing new treatments and drugs and medical devices, it allows them to reduce their costs through outsourcing to the CRO. That's, in a nutshell, what it is. Shepherd you through phase 1 through 4 trials and that sort of thing. So he launches this company in 92. He's still CEO today, Chris. This is 30 years on the job almost. I think he's probably pretty decent at what he does. He kicked around in private equity. He had it personally for a while, then private equity for a while. It IPOs in 2016. He still owns somewhere between 20 and 23% of the shares of this company. I'm not sure with the recent buybacks what he's up to now. He put up $20 million of his own cash at the IPO to buy shares in his own IPO. So that's kind of neat. Once it was taken public, he used the company's copious cash flows to buy back all of the debt that he was left with at the IPO. The company's debt-free today. He bought back a bunch of stock from his former private equity sponsors, so he's free and clear. And today, the company has a debt-free balance sheet, $278 million in cash on the books. It's free cash flow production since IPOing, like I said, in 2016. From 2015 to 2020, free cash flow has compounded at an annualized 23.4% rate. They did $277 million last year. Okay, no place to put it except for buying back shares and buying on the balance sheet, really. The company, even as the conference call this week, Medpace CEO August Trendle basically says, yeah, 20% growth is kind of what we're comfortable with. We're not really straining above that. This is kind of our sweet spot. He's only done it since coming public. And like I said, he's run the business for 30 years. And this is a company that you can buy today for 5 times this year's expected revenue and about 25 times this year's expected EBITDA. It is a high quality business that I've never heard another fool mention. So, like I said, I pulled out Shopify, which we all know and love, Appian, The Trade Desk, Ditto, etc. Smaller company, $6 billion, but I think, fools, this is a company that, we talked about Bedrock Company. Now maybe get some growthy names in there as well. This isn't as sexy as a SaaS business, and that's fair enough. But you need some of these kind of mid-tier can kind of grow at, high teens, low 20s rates for almost as long as they want. And when will Wall Street notice Medpace? Maybe when it hits 10 billion, 20 billion, I don't know, but you could say you were in now.
When you look at the valuation of the business, this is a stock, it's down a little bit from its high. It's still up more than 60% over the past year. It sounds like it doesn't look overly expensive to you.
I believe you will generally have to pay up for quality. And so this is not a rock bottom price. Ironically, Walmart's more of a rock bottom price than this one is, but it is a fair price for a great business run by a very foolish founder management team with skin in the game, and he's built it as a fortress. So even through the pandemic, where they did what everyone else did, they pulled their guidance and they talked down expectations and said, and then they have the full year results and they smashed them. So, that's what they do in bad times. And in good times, they do better.
Quick programming note. This weekend on Motley Fool Money, it's our 12th anniversary.
Yay.
12 years ago this week, we started Motley Fool Money. And just for some context, the S&P 500 was at 770. Today, at just under 3,900. The NASDAQ was at 1,440, and right now the NASDAQ is at, let's just call it 13,700 and change. So you're welcome. That's right. I'm claiming all the credit.
Taking all the credit. Well, I don't get any credit because I think I've been on exactly one Motley Fool Money show in 12 years.
I can't do anything about the laws that the leadership in your government has set up with respect to like cross-border? Like look, I'm not going to cross the Canadian Mounties. That's suicide.
Yeah,
bro.
they'll tell you to stop it again, right?
Exactly. Our email address is marketfoolery@fool.com. Got a great question from Charlie in San Francisco. He says, as a relative newcomer to the Motley Fool, I love the insight. It's definitely helped me navigate the crazy year with a cooler investing head. My question is about Electronic Arts' acquisition of Glue Mobile. As a Glue Mobile shareholder, how do I weigh up whether to sell my Glue shares or hold for the sale and take the shares of Electronic Arts? I'm in it for the long term. No need to sell. I'm just unsure what is the best response as an investor in the acquired company. I love this question because this is a situation that a lot of investors find themselves in. If you're an investor for a long enough period of time, it's, I bought shares of this company. I've got my bull case for this for company X, and they got bought by company Y. And I don't know that I want to be a shareholder of company Y. So what are a couple of things that investors should do to sort of answer that question for themselves?
Yeah, Charlie, it is a great question. As Chris says, I will say I feel your pain. This has happened to me twice this month. And because I don't really know anything about Glue Mobile and not much more about Electronic Arts, I'm going to speak in generalities and also kind of talk to you about how I've approached this with the two companies that I've gotten this happen with me. First off, it can be great when your company is acquired for a fat premium, or it can be awful because you had multi-bagger hopes for them. And I've had one of each of those this last month. So the good news is you're getting a 36% premium. The bad news is you don't really have, or not really bad news, but you don't have the choice to take EA stock here. Okay, or if you do have the choice, it's you're going to have to do it because they are paying $12.50 in cash for every share of Glue Mobile. So for you to roll that into EA, you're going to have to either wait for the cash to be received and then buy shares of EA at that point, or you could sell Glue today and buy EA. And of course, that necessitates a bunch of questions. And the questions are, this happens every time you go through this, and the first question is, how excited are you to own the acquiring business? Okay, so you have to start, what made you buy Glue Mobile? Those reasons may indeed survive in the combined company. But, Electronic Arts is a $42 billion company, and Glue is about a $2 billion company. Glue is going to be less than 10% of the combined company's total revenue. I'm going to predict that the culture that survives intact is probably going to be Electronic Arts. It's probably, the things that you like about Glue is probably going to be absorbed into. A lot of people from Glue will probably be exiting the company within a couple of years. That's just what happens. And Peter Lynch talked about this phenomenon a little bit in One Up on Wall Street, I believe. Might have been Beating the Street. But he talked about, there might be a company or a product that you love, but if it's trapped within a bigger company where it doesn't contribute much or can't contribute much, you kind of get played out. So that's not great. One thing I like to do as well is I consider the valuation argument. So EA, for example, right now closed yesterday at about 6.5 times sales, and it's trading for about 16 times next year's EBITDA, which is kind of our rough first glance at cash flow. I look at Glue, and Glue is trading at about 3.5 times sales, which I was kind of surprised at. It's actually a lower multiple. And it's trading at about 19 times next year's EBITDA. So 16 for EA, 19 for Glue. So that actually doesn't look that bad, frankly. In fact, it looks like EA is getting a bit of a bargain, depending on how you want to look at valuation-wise. But EA is growing slower. So even though the forward valuation is a little more favorable for EA, the slow growth where they're going to dominate whatever Glue puts up gives me a little bit of pause. That's my thing. And I'll tell you the story. Like I said, I've had this happen to me twice this week. The first company is a company called CRH Medical this month. CRH Medical is a company I like, company I own, still own. It's being acquired. It always had something, Chris. There was always something, like they did well, but there's just they tripped over their own feet a few times. So, out comes this other company called Well Health that's buying them with an 80% premium. It's done and dusted, let's go. Because as I look at the acquiring company, it is a much higher growth through acquisition. It's a cash burning company. It's trading at well over 10 times revenue. If you grant them all of their acquisitions together, it's still trading at over 10 times revenue going forward versus my CRH company, which is trading at less than 4 times revenue. They're clearly buying CRH to use that cash to slake the cash burn over it. Well, not willing to go up on the valuation chain. So goodbye to those assets, and we're good as my camera turns off on me. The other one is a company called NYSE, which goes by the ticker EGOV on NASDAQ. It is a great company, really well run. It brings government processes online. So if you need a permit for a camping site, you got to pay a parking ticket. Chances are NYSE developed the app for it. It is a fantastic company that I had great hopes for. I'm sad to see it being taken out by Tyler Technologies, which is another great company. So I'm enthused about both companies here. I think Tyler is an excellent company. I think NIC is an excellent company. The problem is that NIC trades for about 4 times revenue at the acquisition multiple, and Tyler is at more than 10 times revenue. It's more than 70 times free cash flow. Again, I am not willing to swap what is a lower valuation company for a higher valuation company where my preferred company, that would be NIC, is just 30% revenue and growing at a slower rate. So, you start to ask yourself these questions. What is the acquiring company? What are the traits of the acquiring company? How excited am I to be there? What does the valuation look like? And that could, that could hopefully form your answer. Again, you're getting a 36% premium on where Glue was before the acquisition was announced. I hope you bought it closer to its 52-week low, which is in the $3 or $4 range. So you're making out like a bandit here. But even so, 36 is nothing to sneeze at. So these are kind of the things you want to ask. And, look, if you do nothing, you're going to end up with cash. And maybe I think Glue's trading slightly above the acquisition price or proposed price. So, maybe there's some hope that someone comes out and offers a superior price to EA. Can't say for sure whether it'll happen. It's not that big of a premium, but maybe you might get someone else to play here, but EA would probably come back and say, well, okay, we'll offer $13 or something. So, but there are worse things to have happen. I'll put it that way.
Absolutely, and to bring it back to Walmart, and you sort of touched on this. A question everyone needs to ask themselves when they're in this position is, well, what place does this stock occupy in my portfolio? As you said, Glue Mobile, it's a smaller company. It's, maybe more on the growth side of the equation. If, to take this to an extreme, if instead of Electronic Arts, buying Glue Mobile, if Walmart bought Glue Mobile, it's like, wait a second, I'm not, I've got the bedrock portion of my portfolio covered. I'm not looking, it's like, no, I'm going to get out of this. I'm going to find myself another, maybe another growth-oriented mobile game company. Always good talking to you, my friend. Stay warm up there.
I appreciate it, Chris, and take care.
As always, people on the program may have interest in the stocks they talk about on the Motley Fool, may have formal recommendations for or against, so don't buy or sell stocks based solely on what you hear. That's going to do it for this edition of Market Foolery. The show is mixed by Dan Boyd. I'm Chris Hill. Thanks for listening. See you on Monday.